The 5 fundamental truths. 1. Anything can happen. 2. You don't need to know what is going to happen next in order to make money. 3. There is a random distribution between wins and losses for any given set of variables that define an edge. 4. An edge is nothing more than an indication of a higher probability of one thing happening over another. 5. Every moment in the market is unique. We have to be careful about what we project out into the future, because nothing else has the potential to create more unhappiness and emotional misery than an unfulfilled expectation. There's the compulsive need to win millions, with the simultaneous fear of financial devastation. The markets tease a trader with the very real possibility of fulfilling his grandest dreams of financial independence, and at the same time stand ready and willing to take away everything he owns, and more. Learning to accept the risk is a trading skill, the most important skill you can learn. If you are unable to trade without the slightest bit of emotional discomfort, specifically fear, then you have not learned how to accept the risks inherent in trading. This is a big problem, because to whatever degree you haven't accepted the risk, is the same degree to which you will avoid the risk. Trying to avoid something that is unavoidable will have disastrous effects on your ability to trade successfully. I define random trading as poorly planned trades or trades that are not planned at all. It is an unorganized approach that takes into consideration an unlimited set of market variables, which do not allow you to find out what works on a consistent basis and what does not. Taking responsibility means acknowledging and accepting, at the deepest part of your identity, that you, not the market, are completely responsible for your success or failure as a trader. If traders really believed that anything could happen at any time, there would be considerably fewer losers and more consistent winners. Fundamental analysts could find that a prediction about where prices should be at some point in the future is correct. But in the meantime, price movement could be so volatile that it would be very difficult, if not impossible, to stay in a trade in order to realize the objective. There's a big difference between predicting that something will happen in the market, and thinking about all the money you could have made, and the reality of actually getting into and out of trades. 95% of the trading errors you are likely to make will stem from your attitude to 4 primary trading fears, which is being wrong, losing money, missing out, and leaving money on the table. Keep this in your mind. The successful trader that you want to become is a future projection of yourself that you have to grow into. When it comes to trading, your fears will act against you in such a way that you will cause the very thing you are afraid of to actually happen. Trading is inherently risky. No trade has a guaranteed outcome. Therefore, the possibility of being wrong and losing money is always present. The best traders can put on a trade without the slightest bit of hesitation or conflict, and admit it isn't working. They can get out of the trade even with a loss, and doing so doesn't resonate the slightest bit of emotional discomfort. In other words, the risks inherent in trading do not cause the best traders to lose their discipline, focus, or sense of confidence. The problem is that preventing pain by avoiding losses can't be done. The market generates behavior patterns and the patterns repeat themselves, but not every time. The goal of any trader is to turn profits on a regular basis, yet so few people ever really make consistent money. What accounts for the small percentage of traders who are successful? To me, the key factor is psychological. The winners think differently from everyone else. The consistency you seek is in your mind, not in the markets. Your attitudes and beliefs about being wrong, losing money, and the tendency to become reckless when you're feeling good, that cause the most losses, not technique or market knowledge. It's when you're winning that you are most susceptible to making a mistake, over-trading, putting on too large a position, violating your rules, or generally operating as if no prudent boundaries on your behavior are necessary. You may even go to the extreme of thinking you are the market. However, the market rarely agrees, and when it disagrees, you'll get hurt. The loss and the emotional pain are usually significant. You will experience a boom, followed by the inevitable bust. Some traders do consistently lose, often until they lose everything or quit trading because they can't tolerate any more emotional pain. However, there are also many traders who are tenacious students of the market and have a sufficiently winning attitude going into trading so that, in spite of the many difficulties, they eventually learn how to make money. Those traders who have confidence in their own trades, who trust themselves to do what needs to be done without hesitation, are the ones who become successful. They no longer fear the erratic behavior of the market. They learn to focus on the information that helps them spot opportunities to make a profit, rather than focusing on the information that reinforces their fears. If you believe that anything can happen and that you don't need to know what is going to happen next to make money, then you will always be right. Your expectations will always be in harmony with the conditions as they exist from the market's perspective. To protect ourselves from painful information at the conscious level, we rationalize, justify, make excuses, willfully gather information that will neutralize the significance of the conflicting information, get angry or just plain lie to ourselves. The expectation that you bring with you in trading is often the greatest obstacle you will encounter. There are many traders who end up becoming expert market analysts but can't make a dime as traders because of all the damage they did to themselves in the early part of their trading careers. What happens in these situations is a trader's past will generate so much fear that he won't be able to execute his trades properly or not at all, regardless of how well he learned to predict what the market will do next. Nothing is more frustrating than to know what is going to happen next and not be able to do anything about it. As a trader, it is more important to know that you will always follow your rules than it is to make money, because whatever money you make, you will inevitably lose back to the market if you can't follow your rules.